This is Brian Bowen, and I'm here to talk to you about qualified opportunity zones. This is kind of a capital gains tax strategy, and capital gains is one of those terms that you probably don't know what capital gains are until you have assets. Assets have appreciated, right, which is a good thing. You have a good problem, but it is still a problem, right? It needs to be addressed, and the idea with a qualified opportunity zone is basically the Tax Cuts and Jobs Act of 2017 lets you postpone tax on gains in any investment if you roll the proceeds into an approved qualified opportunity fund, or QOF. It's basically, they were designed to encourage investing in one of about 8,700 state designated economically distressed communities. And the new rules also let you exclude part or all the gains you earn itself if you meet the holding period. So here's the advantage. 1031 exchanges we talk about in our other videos, if you look at our YouTube channel, is a little restrictive because you do have to roll the entire proceeds over. But this is something where you just need to put the gain is. So, for example, you have a $3 million apartment building and you have $1 million worth of gain. Yeah, you made $1 million, which is very good. But the other $2 million was what's called cost basis. You bought it for $2 million, or it depreciated down to $2 million. But either way, your cost basis, it's not taxable, is at $2 million. So you have $1 million gain. Do you want to put all $3 million back into, if you sold it and did a 1031 exchange, it'd all go into the next property? What if you only want to put $1 million back in real estate and you want to put the other $2 million into the stock market, or just spend it on whatever you want? Maybe you want to buy a bunch of cars that aren't an investment, right? You could do whatever you want. You could put it into a business. So there's a lot of ways that a qualified opportunity zones meets the needs of the person, and that's why there's so many different types of tax strategies that you kind of have to look. What we do as certified exit planning advisors is look at their current situation, where you want to go. Are you exiting from this business to go to another one? Or are you exiting this business to retire and you need income? So we have to kind of look at, there's a lot of rules with a qualified opportunity zone. You have 180 days from the date you sell your appreciated property to roll your proceeds into the qualified opportunity zone fund. You make the election on the return for the year when you should have otherwise reported the gains. So you, again, don't have to roll the entire proceeds. But here's one of the advantages. The original gain becomes taxable when you sell the QOF, or December 31st of 2026, which is coming up pretty quick. So you're like, oh, well, it's only a deferral for 2 years. But the amount that you put into the qualified opportunity zone is tax-free after 10 years. So that's the nice. I mean, it's basically allowing you to get some tax-free growth, and you don't have to wait to pass it to your children. So there's some real big advantages. Now, a lot of landmines that you should pay attention to. The rules can be confusing. You need an expert that's going to help guide you to make sure if a qualified opportunity zone is a fit. And there's other tax strategies that you can kind of pull together, so you're not just doing opportunity zones. Other things that you can do to help offset some of this tax if you're exiting real estate specifically. But the one thing that a lot of people get when they hear opportunity zones is they think, oh, this is going to be a really bad area. Well, that's probably the way it was back in 2017. Some of these opportunity zones are very nice, have been completely remodeled. There's areas in the country now are not in bad areas. They're very nice, and high-end hotels and apartment buildings are in there because they've been revitalized. And still, so it's not as risky as you would think, but you still got to assess the risk for the reward. Does it make sense to do this? But a qualified opportunity zone should not be put off the table, especially if you're selling your business or real estate, whatever it could be, or just a stock. Maybe you bought Apple when it was really cheap. Good job. But if you want to sell it, now you can offset the capital gains and roll it into some real estate if that's a better fit for you. So listen to the next video that kind of talks more about other charitable giving strategies that you can eliminate when you sell your stock or your business. Thanks so much for listening.